Hello, today we are going to solve May 2022 paper question number 1. Linda and Rishi are in partnership as retailers. They have some partnership agreement. Then there were balances giving ending balances for 30th April 2022 is given. Then additional information is given. Okay, so let's start solving the part A question. Explain two differences between revenue expenditure and capital expenditure. Revenue expenditure, we know that it means it is an expenditure by the business, or it's an expense, day-to-day expense paid by the business. It acts as a cost to the business, and therefore it is going to appear as in the expense section in the income statement. Okay, and the cost is going to be charged against the income for 1 year. Okay, so that is the two differences for revenue expenditure. For capital expenditure, okay, it is also a cost. It means I'm going to incur a cost by purchasing a non-current asset. Okay, it is also a cost to the business, but it is going to appear as a non-current asset in the financial position, and this cost is going to be spread by charging depreciation over several years. Okay, depreciation expense, okay, over several years. State whether each of the following costs is a revenue expenditure or capital expenditure. So we have to just see whether it is a one-time cost or it's going to be a recurrent cost. Okay, I am going to use it for every year. So let's see. First one is the redecoration. So redecoration, I might do it every time. Okay, so it's a revenue expenditure. Okay, it's a revenue expenditure. Then if I have additional computer equipment, okay, additional computer equipment, then this is going to be a one-time purchase. I don't keep purchasing computer every year, or maybe, and then also it is going to appear as a capital. It is an asset. Okay, it is an asset in the with the business. Advertising, this is also, I might advertise and it's not an asset, so it is like an expense, so I will call it as revenue expenditure. Next, prepare the journal entries including the bank entries to record the premises refurbishment costs in the books. Narratives are not required. So this is with regard to the additional information for the fifth one. A premises refurbishment had been completed on 20th April 2022 and no entries had been recorded in the books of account on 30th April 2022. The premises refurbishment consisted of the following. So let's start putting the journal entry. Okay. So this involves some of them not being recorded, and so we have to see how do you correct these entries. So first one is a redecoration cost. Okay, the redecoration cost of 12,000. Okay, 12,600. This had been paid by check. This had been paid by check. Okay, so what are the two accounts that's going to get affected? So first one is bank. Okay, because it was paid by the check, and there is a redecoration expense account. Okay, there will always be an expense account. See, redecoration account. Okay, so redecoration, so, and 12,000. So because it's going out of the bank, okay, this is debit and this is credit. So in the bank, this 12,600 is going to appear on the credit side, right? It's going out of the business. In, out. Okay, that's also a way to remember for this. I have to put it's a pound. Okay. So 12,000 if it's going to appear on this side, and redecoration it says is an expense account, so it is going to appear on the debit side. Then we have additional equipment, computer equipment, so it's an asset, so definitely I'm going to have a computer. Okay, I have to update my asset. So okay, computer account, equipment account. And then, but this was purchased on credit, okay, not by the check, so from JK Computers, so he becomes a trade payables account. Okay, so you are going to put computer equipment I purchased. Okay, so it is going to appear as 6,000. Okay, it came into the business. And JK Computer we are liable to pay, so I'm going to put it as 6,000 credit. Okay, we have to pay. Then we had a new advertising, so advertising itself is an expense account, so that is definitely going to come. Okay, advertising. And then it was for the premises 2,400, so let's write here it's an expense account, so on this here it will definitely appear on the debit side. Then a check 1,800 was issued, so let's write the bank. Okay, it went, so how much I gave. Okay, so from whomever the business bought, so 1,800 was issued, so it is going to appear, this is an out. Okay, account, so 1,800 on the credit side. The balance is owing to the SolvePaperz, so let's write the SolvePaperz. So they become the liability. Okay, business becomes the, this is a liability account I'm maintaining. So and I still have to pay 2,400 minus 1,800. I am liable to pay, that is around 600. So let's write that. Hello, today we are going to solve May 2022 paper, question number 1, and this is part D. Prepare things that's going to come here. So first one is the revenue. Okay, then we will have cost of revenue. The next one is cost of sales we have to find. For that, first we have opening inventory, and then purchases. Then we have less closing inventory, and then we have to do cost of sales. Then we have to do cost of sales, but I also see carriage inwards. Okay, so purchases, and then we also have to add the carriage inwards. So carriage inwards. Carriage inwards is the money that is paid. Okay, that is paid for purchasing inventory by the business. So we have to add to the purchases cost. So add purchases plus carriage inventory, that is the total purchases that's going to happen. Okay, and then that will give you the cost of sales. After finding the cost of sales, you have to find the gross profit. Okay, before that, so yeah, after finding the cost of sales, we have to find the gross profit. So we have to check whether allowance for irrecoverable debt. Okay, if there is an increase, it can become income, else it will become an expense. So let's is 8%, 5% of 8,000. The current trade receivables is 1,000. So there is a decrease in allowance. Okay, current trade receivables. Okay, current trade receivables they have maintained. Okay, they have maintained is 1,000. So current is equal to 1,000. So decrease in provision it will become an income. Okay, it will become other income. So that is equal to 1000 minus 400. That's 600. So that is equal to 600 other income. So let's write that. So allowance for irrecoverable debt. Okay, so the allowance for irrecoverable debt is also coming as an other in fixtures. And then apart from that, we have rent and insurance expense. Irrecoverable debt is an expense, advertising is an expense. So we have covered everything. Okay, so we start from here. Okay, all these are expenses. Now let's start putting all of the values here. So first one is the revenue. Okay, the revenue is 570,000. So 570,000. Then we have the opening inventory 61,000. Okay, opening inventory is 61,000. Then we have mention this as pounds here. Okay, everything is pound. Then purchases is 390,000. So 390,000. Then we have the carriage inwards 3,600. Then we have to less the closing inventory. The closing inventory was 72,000. So less the closing inventory. So let's find the cost of sales. So 61,000 plus 390,000 plus 3,600 minus 72,000. So the cost of sales will be around 382,600. So let's write that 382,600. Now we have to find the gross profit. So this cost of sales we have to less from the revenue to get the gross profit. So let's write that also. So revenue minus cost of sales. So that is equal to 187,400. Then we have the other income. So commission receivable. Commission receivable was 6750. So let's write that. Commission receivable was 6750. Then we have the staff wages 57,500. Okay. So commission receivable we have 6750. Then allowance for irrecoverable debt, we know that it got decreased and the decrease amount now is 600. Okay, so we had calculated earlier from here. Then expenses, carriage outwards is 8,100. So let's add up this other income first before. Okay, so 6750 plus 600, that is 7350. 7350. And that you have to add with the with the gross profit. Okay, so let's add up with the gross profit. So plus 187,400. So that should be equal to 194,750. So 194,750. Now let's write all the expenses that's going to carriage outwards. As I already mentioned, it's paid by the business for delivering the product. Then so that's 8,100. Then staff wages 57,500. So let's write that 57,500. And then we have general expenses. And then we have the general expenses of around 9,200. So let's write that 9,200. Then management salaries were around 38,000. So let's write that. Then we have to calculate provision for depreciation. Okay, so we have to do the working. So let's write here. So provision for depreciation. Okay, so the data given is depreciation is to be charged on all non-current assets owned at the end of the year. Computer equipment is at the rate of 20% by reducing a balance method. But there was an additional computer also that was purchased. Okay, so first one is they are going to be using reducing balance method 20% per annum. The cost is okay of the computer equipment. So reducing balance method, so provision or depreciation expense will be cost minus okay accumulated depreciation times the rate. Okay, so that's how you will calculate. Now we know what was the cost. The cost was 50,000 plus 6,000 was bought. Okay, minus the accumulated depreciation was 21,000. So times 20%. So let's calculate this. So you add up 50,000 plus 6,000 minus 21,000 times 20%. So the value will be 7,000. So this is how you will calculate the depreciation cost for the computer equipment. This is for the computer equipment. Now you have to calculate for the fixtures and fittings. Okay, fixtures and fittings. So how will you calculate the depreciation cost for fixtures and fittings? So we have they are at the straight line method. So even if you buy, okay, it will not be affected. It is just going to be affected by the cost present. So fixtures and fittings 15%. So 28,000. So the formula for depreciation expense, okay, depreciation expense for fixtures and fittings will be cost times the rate. So that is equal to, so cost times the rate percentage. So the cost is 28,000, okay, times the rate is 15%. So that is equal to So 28,000 times 0.15, so that is equal to 4,200. So it is 4,200. So this is the depreciation expenses for, okay, this is the provision for depreciation expense calculation for the equipment for the computer and this one. So let's write that. So the expenses is 7,000, okay, 7,000, and then fixtures and fittings we had 4,200. So let's write that. Then we have the rent and insurance. So the rent and the insurance expense was 4,800. So let's write that. So it is 4,800. And then we had the irrecoverable debt. Okay, the irrecoverable debt was around 2850. Okay, 2850. So let's write that expense also. So 2850. And then we have the advertising expense. Advertising, there was a newly furnished and a check of 1,800. So advertising equipment was for the for the newly refurbished premises was 2,400. So 2950, okay, 2950, 7950 plus 2,400. So let's write that. So 7950 plus 2,400. So that is equal to 7,000 plus 7950 plus 2,400, that is equal to 10,350. So the total advertising expense would become 10,350. Now after advertising, we also have to include, there was a premises refurbishment. We know that it is a revenue expenditure, so we have to include that cost. So premises refurbishment, okay, that is around 12,600. Redecoration, okay, it's a redecoration expenses, so that is around 12,600. So let's include that. Now let's total up. So 8,100 plus 57,500 plus 9,200 plus 38,000 plus 7,000 plus 4,200 plus 4,450 plus 2,850 plus 10,350 and 12,600. So this is going to add up to 154,250. So it's going to add up to 154,250. So now let's calculate the profit for the year. So profit for the year will be equal to revenue, the total income minus these expenses. So 194,750 minus 154,250. So that is going to be equal to 4,500. Next we have to prepare the appropriations. Now let's prepare the appropriation section. First let's add the interest on drawings. So the interest on drawings, let's calculate. So 15,000, okay, 15,000 for Linda and Rishi. Now the first one is 15% and interest on drawings given is 8% per annum. So let's write for that. 5% of 15,000, that is equal to 750. And then Rishi we have, sorry, 8%. 8%. So let's calculate the interest on drawings for Linda. 8% of 15,000, that is equal to 1,200. So let's calculate the capital. Let's calculate the interest on drawings. So interest on drawings is 8%. 8% on 8% on the drawing made is 15,000. Okay, so that is equal to 8% of 15,000 will be equal to 1,200. Now for Rishi, 8% on 8% on the drawings made by Rishi was 20,000. So that is equal to 1,600. So let's write that. Now we have to less the interest on capital. For Linda it is 5%. For Linda, it is 5% of the capital was 40,000 by Linda, and for Rishi it is 5% of 60,000. So the values are going to be equal to 0.05 times 40,000, that is 2,000, and so 2,000, and then we have 5%. Okay, 0.05 times 60,000, that is equal to 3,000 for Rishi. Then we have the share of profit. So after this, okay, we have to see what is the remaining profit. Okay, remaining profit after all this, and then we have to share it. So let's add and subtract. Okay, so the total profit was 40,000. The total profit was 40,500. Okay, plus 1,200 plus 1,600 minus 2,000 minus 3,000, that is equal to 38,300. Okay, 38,300. So let's write 38,300, and this has to be shared, okay, in the ratio of equal. So they are giving 50%. Okay, 50% of 38,300. So is shared between the two. So it is 19,150. Okay, it is 19,150. Hello, today we are going to solve May 2022 paper question number E. Okay, first question part E. Prepare the statement of financial position at 31st April 2022 for the partnership Linda and Rishi. So let's prepare the computer equipment. So 50,000 is the cost, but we know that they purchased additional 6,000. Okay, so the cost will become 56,000. 56,000, and for the fixtures and fittings it is 28,000 because there was no additions to the cost. And then we have the accumulated to write it. So 21,000 and this year's expense was 7,000, so the total will become 28,000. So 28,000, and then the accumulated depreciation for this one fixtures and fittings was around 9,000, and this year's it was 4,200. So if you add up you will get 13,200. So let's write that. So 13,200. So you add up 9,000 plus this year's depreciation. Now let's calculate the carrying value. It will be cost minus the accumulated depreciation. So 56,000 minus 28,000, that is equal to 28,000 will be the carrying value. So let's write that. So 28,000, and then we have fixtures and fittings. So 28,000 minus 13,200, that is equal to 14,800. So 14,800. Now let's add up all of this assets. Okay, that's the closing inventory. So closing inventory is a current asset. So let's write that. 72,000. We have trade receivables less irrecoverable debt. So the trade receivables were around 8,000 and irrecoverable debt was 2850. So let's write that. Trade receivables, it was around 8,000, and then so this any irrecoverable debt would have been accounted in the trade receivables account. We have to less the allowance for irrecoverable debt. So lessen the allowance for irrecoverable debt. So that is equal to 400. So this allowance for irrecoverable debt we had already calculated. For this year it was around 400. Okay, so it was around 400. This year's allowance for irrecoverable debt, we have to subtract it from the trade receivables, and irrecoverable debt which has been mentioned as the closing balance is already accounted in the trade receivables account, so you should not subtract. And then we have it's an expense, irrecoverable debt. So let's add up these two. So 8,000 minus 400, it will be 7,600. So we have the inventory, trade receivables less the provision for irrecoverable debts, and then other receivables. So let's check. Okay, for the bank, what happens is bank is at 70. So we have the bank value at 17,350. Okay, and then there was a payment, okay, through checks, 12,600 paid by check. So we have to adjust that because this information came in afterwards, okay, after the balance was prepared. So we have to remove that, and also A check of 1800 was issued, so this also has to be removed. So 17,350 minus 12,600 minus 1,800. So that's going to give you 2,950. Then rent insurance, okay. The insurance 800, okay, which was prepaid expense paid in advance, okay, prepaid expense, it becomes other receivables, okay, it becomes other receivables. So the insurance prepaid was 800. Expense was prepaid, so it becomes as other receivables. Then let's add up all the non-current asset value. So 72,000 plus 7,600 plus 2,950 plus 800. That should be 83,350. Okay, this is the thing, and let's add the total asset value now. So the total asset is 42,800 plus 83,350, that's 126,150. So that's the total assets in the business. And then we have the liabilities section. Okay, let's prepare capital and liability section. Capital. So the first one is capital accounts. From the capital accounts, the balances were at 40,000 and 60,000. Okay, for the Linda and Rishi. So let's write that. It was 40,000 and for Rishi it was 60,000. And then we have to add the current accounts. Okay, so this is let's write here, okay, at the top for the Linda and Rishi capital accounts. Now the current account balances, okay, which we had prepared was 69, 50 and 1000. So current accounts balances which we did so was 60, 6950, 6950 and 1000. Now let's add up all this. So the total capital, okay, the total capital will be here 100,000 and total current account will be equal to 6950 plus 1000, it will be 7950. So we have the total of current accounts. Now let's calculate the current liabilities. Okay, so current liabilities will be So the profit has been shared and it has been adjusted for the current account. So we have this as the statement that is given for the partnership for capital account and current account. Then current liabilities, okay, the current liabilities are going to be, so trade payables, so any trade payables will become current liability, and also what are the other payables, okay, so trade payables is a current liability, and other payables are any owed expense, okay, any owed expense is going to become the trade payables. So the thing is, we had trade payables of around, trade payables was 11,150, but apart from that some more became payables, okay. What are the payables we have? 11,150 plus, when we did the journal entry, okay, we know that there was two other trade payables it had become. One was a JK computer which was 6,000, and North Town newspaper which was 600. So let's add that. So the total trade payables is going to become 11,150 plus, okay, 11,150 was the trade payables. Then we have to adjust two other things, that is 6,000 which was still owed to the one of the companies, and the other one is 600. So when you add up, it's going to be equal to 17,750. It's going to be 17,750. Now we have the other payables, okay, which was owed rent, that was rent and insurance. So the rent was 450, so it had become other payable. It's an expense, owed expense, okay, you had to settle it immediately, so it's a current liability. So the value is going to be equal to so that was the rent owing was 450. So the total trade payables, okay, let's add up these two. 17,750 and 450, that will be equal to 18,200. Now let's add up the capital and the liability section, okay. So we have 100,000 plus 7,950 plus 18,200. So that will be equal to 126,150. So if you get both the total assets and the total liabilities, okay, this is the total capital and liabilities, they both are the same, your answer is correct. They should balance out each other. Hello, today we are going to solve May 2022 paper question number 1, part F. Linda and Rishi sell many of their goods on credit. They are considering changing the method of sale to cash only sales. Evaluate the possible change of method and sale to cash only sales. So let's evaluate this. If they assume, we assume that Linda and Rishi sell all their goods for cash, then the positive points for that will be there will be improved cash flow in the business. So if they have sufficient liquidity in the business, they will be able to meet their daily expenses for paying wages or electricity or whatever it is. So improved cash flow. Then there will be no irrecoverable debts happening. Okay, so which means less expense cost to the business, and also there is no credit control policy or bookkeeping has to be done, so it is going to save some time and cost to the business. Also they don't have to offer any cash discounts. Okay, if somebody pays in cash, so less expense cost to the business. But however, the negative points for selling for cash only will be less customers will be willing to buy because they will not have such a big amount of cash. This means less sales for the business can happen, and also there might be fear of theft. Okay, when they collect a lot of cash and keep it in the business, they will have to maintain that security, so it might increase time and cost to the business. If they don't maintain books, okay, for the credit or something, or for the cash dealings or for the credit dealings, then they will not be able to track for future purposes, which means it can affect the business reputation if they have to make some business decision. Then also there is any big purchases, okay, of the large amount of inventory, the customers might want some discounts and also give them credit, so they might go to a competitor who offers such features, and so which means the business again will become less competitive. So in conclusion, we can say that for small inventory, okay, they can use the credit payment, but for the credit payment for small inventory, okay, small inventory or the goods, okay, for the small goods they sell. So small value goods they sell, and they can and for big value, okay, for big value so it is better to use credit control policy. So in conclusion, we can say that it is, okay, it is better to use credit payment for big value good, and they should use cash payments for big value goods sold.